Good day to everyone. Today I will be presenting a financial analysis for CAB Cakaran Corporation Berhad, using various financial ratios as tools to understand its performance and financial health. CAB Cakaran Corporation Berhad is an investment holding company that produces food products for the domestic and international markets. It operates through the following business segment: investment holdings, integrated poultry, quick services operations, and supermarkets. Let's dive into the financial ratio that provides insights for CAB's performance. We will cover key ratios, including profitability, liquidity, and leverage ratio to paint a comprehensive picture of the company's financial standing. From Table 1, we can see that there are 4 good signs of ratio show. First, net profit margins. CAB has significantly improved its profits margin from 2.88% at 2022 to 6.30% in 2023. Why did the net profit may increase significantly? This indicates enhanced profitability, possibly due to better cost control and increased revenue. From Table 2, CAB has grown in revenue, gross profit, and operating profit. One of the main reasons is the increase in sales prices of chicken products. Another reason is that subsidy they received was Ringgit Malaysia 30.13 million, more than the previous financial year. Not only that, but they managed their cost of sales very well, and their costs represent only 88% out of 100% of revenues. They achieved more gross profit by lowering their cost of sales compared to last year. Finally, you can see that they managed to maintain the same operating expenses ratio. Second, ROCE, return on capital employed. Their ROCE has nearly doubled from 2022 to 2023, showing more efficiently use of capital. Effective capital allocation of CAB may have made more effective decisions regarding capital allocation in 2023. Now, let's see at the current ratio. CAB current ratios is improved from 1.02 times in 2022 to 1.27 times in 2023. The CAB current ratio is still have a gaps to improve to 2. CAB is increased from 0.872 times in 2022 to 1.082 times in 2023, indicating that they have a better ability to cover interest expenses with operating profits. In the other hand, we can see that there are 3 main issues occurs from the Table 1. It might cause them to facing some challenges. The first challenges we can see that from the gearing ratio. The gearing ratio has dropped slightly from 64.23% in 2022 to 61.87% in 2023. Despite this reduction, the level of debt relative to equity remains high. As a high gearing ratio, over 50%, signifies substantial financial risk. Second challenge, let's look into the PE ratio of CAB. The decrease in CAB's PE ratio from 5.8 times in 2022 to 4.16 times in 2023. A lower PE ratio might indicate undervaluations or concerns about future growth. One of the CAB's competitors is QL Resources Berhad. It is a leading company in the farm, agriculture, and food processing industries. From the Table 3, we can see that overall, CAB and QL perform well in terms of profitability, liquidity, and efficiencies ratios. Both companies are pursuing revenue maximization, short-term financial health, and good business operations management. There is 2 points that CAB can learn from QL Resources Berhad. First, it is the CAB's gearing ratios are higher than QL's ratios rate, and also over the average of gearing ratio, normal, acceptable ratios rate. Second, it is the price to earning ratios, which is called PE ratios too. Third, let's look at Table 4. Cost of sales from both CAB and QL have high cost of sales relative to their revenues, but CAB's cost difference means that CAB spends a larger proportion of its revenue on producing its goods or services compared to QL. Last but not least, to enhance values for CAB, based on our analysis, we have several recommendations to enhance the value of CAB Cakaran Corporation Berhad. First, improve profit margins efficiency. Focusing on cost management and operational efficiencies can enhance profitability. Second, strengthen liquidity. Ensuring adequate liquidity can help the company manage short-term obligations and unexpected expenses. Third, reduce financial leverage. Lowering debt levels can decrease financial risk and improve financial stability. 4. Re-evaluations of dividend policy. Reviewing and potentially adjusting the dividends policy can balance between rewarding shareholders and reinvesting in growth. By focusing on these areas, CAB can enhance its financial performance and align more closely with industry benchmarks, thereby increasing its value propositions to shareholders and potential investors. Addressing this area, CAB can enhance its financial performance, reduce risk, and create more value for its shareholders. Thank you.